A lot has transpired in the financial sector in the last several weeks, and especially in the last 2 weeks after Silicon Valley Bank went bankrupt. In the United States, a second bank, Signature Bank, has subsequently been placed under FDIC receivership. Since then, the Federal Reserve Treasury and the FDIC have insured all deposits for these dissolved banks. First Republic Bank, a third regional bank, appears to have been spared by a $30 billion deposit made by 11 other significant U.S. banks as a show of confidence to help calm the markets. To help calm things down even further, the Federal Reserve established a special lending program to assist banks in borrowing at the par value of their treasury assets, and Silicon Valley Bank's parent company, rather than the bank itself, has filed for bankruptcy protection. Many are attempting to figure out what this all means for the U.S. financial system, how it will influence inflation, how the Federal Reserve could alter course or if they will change course around interest rate rises, and if this would shift incentives for both depositors and banks given the seemingly endless insurance for systematically significant banks. Yet, none of it is relevant today since the greatest news out of the banking industry is the apparent demise of Credit Suisse. If you're unfamiliar with Credit Suisse, they're based in Switzerland but have a very large international presence, particularly in investment banking, and they've been identified as a global systematically important bank in the past, which means that if they fail, it would have significant implications for the global financial system, so pretty high stakes. Many were convinced that this foreign bank was on the verge of collapse due to the very shady actions that we had seen from it in recent months and even years. But that all culminated last Sunday when we learned that UBS, another Swiss bank and competitor to Credit Suisse, would be purchasing the company. While this may have been one of the best results that we might have seen in the circumstance, the fall of this multinational powerhouse convinced people that this is it. This is how the world's financial system falls apart. But I just want to provide some context, not to minimize the real risk that we're seeing in the banking sector, but to demonstrate that Credit Suisse isn't necessarily a canary in the coal mine for the international banking community because it was a special bank. To put it another way, we're getting ahead of ourselves. Before I continue on with the video, allow me to introduce you all to economic news. Please like the video and subscribe with all notifications turned on by ringing the bell icon so that you can stay up to date with all the news coming out in the banking industry. Now, let us get back to the video. What occurred with Credit Suisse? In comparison to American banks, which were hit the worst by the liquidity crisis, Credit Suisse suffered as a result of being a terrible firm. They've had some dubious ethics and even more questionable earnings for quite some time. And with problems for this bank constantly coming to light as of 2023, their reputation as a financial organization has truly plunged to some of the lowest lows. They did employ a new CEO last year to try to turn the firm around, which included spinning off its investment banking session and even raising investment from Saudi National Bank, which purchased a 9.9% interest in Credit Suisse, making them the largest shareholder. The bank released its 2022 results in February and they were not encouraging. The bank recorded a full-year loss of 7.3 billion Swiss francs, which is about equivalent to US dollars. And similarly to banks in the US, the corporation reported huge withdrawals from their institution in the fourth quarter of the year, with deposits falling by 140 billion francs, or roughly a third in the last quarter alone. While this alone led the stock to plummet nearly 15% on the day these data were disclosed, things only got worse from there. According to sources, in a desperate attempt to get consumers back into the bank, they were giving a 6.5% annualized rate of return on a 3-month term deposit, which is far more than what you would earn elsewhere for a safe return. On March 9th, the company delayed its annual report filing due to a note from the SEC. And the following Tuesday, the company announced that there were material weaknesses discovered in its 2021 and 2022 financial reporting, despite the fact that it claimed that its financial statements were still accurate, but the markets did not believe them. And who can blame them after a Silicon Valley bank, so the stock traded down 24% to an all-time low, which was not helped by Saudi National Bank. Many believe that with the failure of Silicon Valley Bank, Credit Suisse would be the next bank to go, and a larger one at that. But following the big sell-off, Credit Suisse announced that it would borrow 50 billion Swiss francs, or roughly 9.4% of its asset balance, from the Swiss National Bank through a covered loan facility and a short-term liquidity facility, both of which would use the company's assets as collateral. This did assist the stock a little because the bank now had the backing of the Swiss Central Bank. But at the end of the week, the business was still trading at a market cap of roughly $7 billion, or around 1% of their total assets. When you consider the market capitalization, this globally significant bank was trading at nearly the same dollar valuation as World Wrestling Entertainment Incorporated. Talk about a smackdown! Yet, it was not the end of the stock market's anguish, since 2 weeks ago on Sunday, it was reported that UBS, Switzerland's largest lender, would be merging with Credit Suisse for 3 billion Swiss francs in what many are calling a shotgun marriage given the participation of regulators who are also providing a liquidity line of $100 billion and a loss guarantee of $9.7 billion. Curiously, regulators entirely circumvented shareholder voting rights with this purchase and actually broke the traditional investment hierarchy by forcing bondholders of the bank's AT1 or more Tier 1 bonds to lose all of their money in the sale, while ordinary shareholders are still getting something for their shares, which is quite rare, but regulators have stated that this is due to the exceptional condition of this takeover. That's about it. Not the ideal conclusion for investors, but probably a better one for pretty much everyone else, given that we now have a less scandal-prone bank running this business of backing deposits. And hopefully we'll be able to turn the firm around given the strategic efforts that the bank was through. Despite the fact that this bank's savings and activities were officially protected, there are still concerns about the banking system as a whole. Some believe that central banks are simply pumping up this sector in order to sustain it and push the can down the road. Despite the fact that many of these banks have failing assets that cannot cover their obligations because they have lost too much money and have exposed themselves too much to rising interest rates, reducing the value of their balance sheets. While all of this is quite alarming, I do want to emphasize several areas of nuance that are often neglected by many of these recaps. Many saw Credit Suisse as one of the stock market's slowest moving train wrecks before the more severe headwinds associated with bank runs. The shares had lost 90% in value from 2014 to the end of 2022. While the rise in interest rates and the prospect of bank runs hastened the end of the drama, it is truly a story of a poor bank in a terrible climate. Despite its name, Credit Suisse has lost a lot of credit due to unethical business practices and declining revenues. It wasn't simply investors who were unwilling to touch the bank. It was also clients who would gladly to do business with another organization that did not have this kind of reputation. Thus, if you were to ask anyone which global systemically important bank would be the first to fail when circumstances were tight, you could bet a lot of money on Credit Suisse. In reality, there was money on Credit Suisse collapsing. That's not to say it doesn't matter, but when people are concerned about the macro problems affecting the banking sector as a whole, it doesn't make sense to use the bank with probably the worst reputation in the world as a barometer of the group's health. The second point I want to emphasize is that despite the fact that this bank was taken over and appeared to be on the verge of failing despite its recovery plans, the business's management and others have stated that the company had a healthy balance sheet during most of this. Now, I understand that a company telling you that it has strong liquidity and a healthy balance sheet usually means the opposite, but the company did highlight that it still had a high liquidity ratio in mid-March, and this was regulatory bodies showcasing that Credit Suisse continues to meet the liquidity requirements that come with being a global systemically important bank. I know what you're thinking. That was the case for US regional banks before interest rates began to climb, causing their bond holdings to plummet substantially. But this is where the scenario varies quite a little. One of the major accusations leveled at Silicon Valley Bank is that they did not manage their interest rate risk properly. Many banks attempt to hedge at least some of their interest rate risk, which means that while they may own long-duration bonds, which are bonds that have been outstanding for a long time and are more sensitive to rising rates, they may also enter other positions that have the opposite relationship to interest rates, where rising interest rates actually increase their value. This assists them in managing their interest rate exposure, something about Silicon Valley Bank, once again, did not do well. Credit Suisse, on the other hand, is said to have fully hedged its interest rate exposure, which means that if it were to sell all of its assets, or at least its investment assets, the value would not have changed much as a result of interest rate changes. One major reason for this is because Credit Suisse and many European banks face far more strict regulatory standards than Silicon Valley Bank did. Not only do the Basel III Accords, which were implemented following the 2008 financial crisis, impose more stringent requirements on European banks, but Credit Suisse, as a global systematically important bank, had higher standards that it had to meet in terms of leverage, liquidity, and interest rate monitoring or management. Meanwhile, in the United States, while major banks are required to adhere to the Basel III Accords and rigorous regulations in this regard, regional banks are not. Admittedly, a lobbying group in the United States has been very successful in pushing for the deregulation of regional banking, which explains why a failing bank in the European system may end up with a healthier balance sheet and assets backing the value of its deposits when compared to a US regional bank that isn't subject to the same requirements. While US banks have been more profitable than international peers as a result of these deregulation moves, it appears that this has come at a cost, which hopefully explains why the Credit Suisse situation differs from Silicon Valley Bank and other institutions in the US that have suffered more acutely from rising interest rates, which ironically are actually better for banks in the long run. Banks actually earn more when interest rates are higher, but the majority of the problems that Credit Suisse was experiencing were company-specific. That is not to argue that the macro didn't have a part in hastening those difficulties, but they were a one-of-a-kind circumstance that should not be used to symbolize the worldwide banking community or the health of that sector. Nonetheless, a really worrying scenario and a very sad narrative. This bank was founded in 1856 and was nearly 160 years old. It survived the 2008 financial crisis, but has now collapsed following years of scandals and bad corporate direction. It appears that 2023 is attempting to outperform last year, but this is not going to be the end of the banking issue as a whole. Whether within the United States or abroad, the ramifications of these activities are likely to be seen, for better or ill. Only last week, we discovered that central banks around the world are coordinating efforts to enhance access to US dollars in order to help prevent future bank liquidity worries. Clearly, there is a continuous effort to battle contagion, and while we may have seen the biggest financial headlines of the year, this is still very much a developing story, so we'll have to wait and see what happens. Thank you for watching this video. Please leave a comment down below mentioning the other banks that you think are going to fail this year, as well as your opinions on how to lessen the blowback from this financial crisis. Also, if you have time, please do check out our other videos on the channel. Take care now, and I hope to see you in the next video.